The market's waiting for tomorrow's key employment report. That's right, it's finally Jobs Friday. This is all happening as Treasury yields continue to slide from historic levels. For more on what's been driving the bond market right now, we want to get to our senior economics reporter, Steve Liesman. Wait a second, historic levels, maybe not historic. Recent history? I don't know, Steve.
Yeah. These are big moves we've had in the bond market for sure. And this comes just weeks, Becky, after the 10-year hit 5%. And markets worried, could the government fund that big deficit? Well, bonds have rallied and yields have fallen in what has been the sharpest decline, at least of the year, and one of the sharper ones in several years. The yield on the 10-year, it's down by 87 basis points since mid-October when it touched near 5%. And about 37 basis points of that have come just since Thanksgiving. John Canavan of Oxford, he says what's been driving the 10-year has been better inflation data, repricing of the Fed, and hedge funds covering their shorts. That's just one piece of it. You also have pension funds and insurance companies moving to lock in those long rates before they miss them. And that's driven in part by this growing belief the Fed is done hiking rates and will cut next year. In mid-October, the market was priced for about 70 basis points of cuts next year. That has nearly doubled, with 130 basis points now built in and priced into Fed funds futures markets. And that cuts beginning as soon as March. Rick Reeder, though, of BlackRock, he tells me, quote, I think the front end is over its skis. I don't think they'll be easing in March. Markets will be watching carefully another round of big Treasury auctions next week after poor auction results led to stock sell-offs in October. 3- and 6-month bills, $143 billion, 3-year notes, $50 billion. These are just massive numbers. 10-year notes, $37 billion, and the 30-year, all of that happens next week. For now, it seems lower inflation, hedge fund short covering, and a belief in deep Fed rate cuts next year are calming fears of the government and how it's going to fund that $33 trillion deficit. But this bond market, as you can see there, it's shown sentiment can turn very quickly back to fear and concern, Becky.
Yeah, I think that volatility is what has so many people on edge. What about some of the international buyers like China and Japan, Steve?
You know, I did some work on that, Becky, and my friend Lou Crandall, who covers the Treasury closer than maybe anybody in the whole country, he sent me this chart, and it shows that China and Japan have not over many, many years been huge buyers. If you look at foreign international holdings of Treasuries, what you see is that China and Japan, they hold a lot of bonds, but they've not been moving very much. Everyone else, though, has. So we have found international buyers. It's just not China and Japan. And, of course, Japan going through its own issues with yield curve control. So that's something to watch, Becky. I don't know that, obviously, they hold a lot of bonds, but they have not been big marginal buyers, despite what people think.
Yeah, they haven't bought more as we've been issuing more. I guess that's the point on it.
Right.
Like, they haven't expanded to our view of the expansion.